Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for joining us for this week's Market Carver. We've got three topics to bring to you. A couple more as we recap 2022, especially as we use that information to apply lessons and things going forward. We're going to talk about asset class performance. We're going to look at sector spread, and then we're also going to take a look at how annual returns typically come. So we're going to first break down the asset class performance. So this type of chart that we show up here is called a quilt chart. I really like, Andrew, how you described this, or at least gave somebody the idea to actually make a quilt out of this. So maybe if you have a grandchild or something and you're a quilter out there and they also like financial markets, here's an idea for you to start working on for Christmas.
Be the nerdiest quilt ever.
Hey, who doesn't like a good quilt? I don't care who you are. This would be a good one. But each of the box represents a different asset class, and it's a good way to look at the performance of each individual asset classes. So you can see all the variety of collars going back to 2013. You got small caps, mid caps, large caps. When we say that, those all three are domestic stocks. We look at all three different baskets. They can perform differently through time. Blue international stocks, we've got REITs, cash, bonds, emerging markets, another segment of international, TIPS bonds, so inflation protected bonds, as well as commodities. The white box is what we call equal weighted. That would be if you had an equal measure of the other boxes, and that would represent a pretty decent, at least diversified allocation amongst a bunch of different boxes. And then you can look at a 10-year chart to see about what you would expect. The U.S. domestic stocks, all three of those boxes have led the way with a 12.5% average return for large cap, and then followed by small and mid cap. So look at 2022, a couple things stand out. The first is that there were relatively few winners. In fact, so the third place, the Treasury inflation protected bonds, came in at a negative 12.2. And there's that white box right below it of bonds, which were down 13%, really representing what made 2022 such a difficult era. But only two actually had positive return. Cash is just barely positive. And then commodities, which we have had increased exposure to, at least more than usual, which was one of the things that helped us at least marginally in 2022. So one of the last things that we'll leave you with is really one of the main points as we ponder going forward. Large caps had a very, at least uncharacteristic of the recent times, bad year, leading the way towards the downside. That was following really a set where they dominated. In fact, if you just take a quick glance along the top, you will notice that orange is everywhere. In fact, 2019 and 22, it repeated as the single best. And in 2021, it was right up there. So it is quite possible that you have a string of year after year where you can have the same asset class be at the top or the bottom. And that's important just because we've had a lot of people tend to think that with the large caps being down, this is their year to return. It may very well be. But history says we can exercise patience, and those sorts of things can take a number of years to pan out. So that's that for asset classes. Andrew, I'll turn it over to you to take the sector side.
Yeah, thanks. So first we're going to take a look at we put the chart up there, looking at the best sectors versus the worst sectors. So like Adam said there, we looked at kind of from a large macro viewpoint of asset classes, now kind of zooming in a little bit more towards U.S. stocks and looking at the difference in performance from the best performing sectors, technology, healthcare, financials, industrials, energy, the different sectors of the market compared to the worst sectors. And so what this chart does is goes back quite a distance, back to the 1990s, and shows the spread in performance from the best to the worst. And what really stood out and why we thought this was an important chart to share in our allocation meeting, and again here on the Market Carver, was last year was the largest spread in performance between the best sector, which actually was energy, versus the worst sector, which turned out to be communications, largely driven by what Facebook was how they were performing. But you can see that we haven't had this large of a spread in performance, really going back to the 1999 and 2000, in a time period where if you weren't exposed to technology, technology was driving everything, until that tech bubble finally popped. And then we had the tech wreck into 21, 22, and then bottoming out around there. And so that's really the last time we saw this wide of a dispersion in performance, showing just the importance of really focusing what type of sectors you have exposure to. A good friend of mine put it well. So instead of being a stock picker in 2022, you really needed to be a sector picker, because it really was important what sectors you had exposure to, because some just really, really got hit hard, while others saw really good performance and helped blunt some of the downturn from 2022. So last year, we haven't seen a dispersion that wide, even during the dot-com period where tech was so strong. So we thought that was pretty interesting to see as we close out 2022. So the last point we want to make is really a lot of people discuss average stock market performance. The average for the market is 8%, or the stock market on average rises 7.5%. And last year was a great example that not all years are average. In fact, when we look at market history, very, very few years actually are average. Looking at the Dow going back to 1900, which is what this chart shows, in fact, less than 10% of the years saw the annual performance between 5 and 10%, giving us that average of 7.5%. That to get an average, you have these big, strong up years, and you have those really, really hard to deal with, but are part of reality in investing, down years. And you can see here's a list of all the different annual performances for the Dow, from the worst to the best. And you can see in the green in the middle is those years that were between 5 and 10%. Like I said, it's less than 10% of the time did the actual annual performance be that average figure. So it just really shows, when we talk about the average return for the market, very rarely is it as a year average. And that's why we often want to look longer term, because what one year does, hopefully, unless it's extremely bad, shouldn't have an overall huge impact on our long-term look at the market, and why being invested for many years can smooth out some of that volatility to where you can work your way to a more realistic average. You'll have some really big years, some really down years. In the long term is where you start getting those averages. So it's always tough when you have a down year like 2022. But again, that's just 1 year, and that's what helps create that average over the long term.
Very well done. And it's astounding every time we see that, just how that plays out over time. So, hey, thank you everybody for giving us a few minutes of your time. I'll give you one last reminder to get with us. We do offer next steps meetings. Come in and we'll give you things that you can think about, whether or not we choose to work together. Come in. The first meeting is complimentary, 800-928-4001, or you can scan the QR code to give us a call. Thanks again, and have a great weekend.